Hello and welcome to BQ Prime. You're watching Earnings with BQ, and my guest today is Vibha Padalkar, MD and CEO of HDFC Life. Vibha, thank you very much for joining us on BQ Prime. The first question, we've seen some softness in the persistency ratio in the 13th and the 61st month. What could be the reason for that?
Our persistency ratio has been fairly flat. It's about 87%. This is on a 13-month persistency, and about 52%, down by about 1% on the 61st month persistency. So it's actually more a rounding if you were to look at it on the first decimal place. Having said that, this also, you will remember that this also subsumes the erstwhile Exide Life, our subsidiary, which has been operating in tier 2 and 3 towns, and its persistency was lower than HDFC Life's persistency. So this is the combined persistency, and despite it being lower, our persistency has remained flat over where it was as of December of last year. So actually, HDFC Life's persistency has gone up, but it's come down to the same levels as last year because of subsuming Exide Life.
Just to get a sense of the profit for the company, you have grown there, but from a street perspective, it's roughly around 7 to 8% below consensus. What could be the reason for that?
Frankly, a 15% growth that you see in terms of PAT, this is very much in line with how we see the back book emergence. And for insurance companies, the faster you grow, and we did grow faster in Q3 than industry. So faster you grow, there is new business strain, so it actually depresses your profits. If you were to deconstruct this and look at what is the back book generation, these are all the policies that we sold back in time, that has grown by over 30%. So it's really the new business strain that is, which is a good problem to have, which has tempered the profits. But I think you will agree that a 15% growth in profit and also 18% overall is a fairly respectable number.
Ma'am, but we've seen some issues around the operating expenses because they've gone up. So could that possibly be the reason why it's still below the estimates?
See, the operating expenses is because of new business strain. That is number one. So, which is my earlier point, that the faster you grow, unlike in a bank, for example, in insurance companies, to grow, most of your expenses are incurred in the year in which you acquire the new business. Unfortunately, under Indian GAAP, you can't straight line it over the life of the policy. So, for example, if the policy is over the 10-year period, then you can't straight line it. As you incur, it will hit your P&L. So, optically, your P&L will show that costs have gone up, but it is towards new business. Second is that these costs subsume Exide Life business, and synergy extraction in terms of both cost synergies as well as top line, that is happening as we speak. For example, HDFC Life had about 383 branches, and the erstwhile Exide Life had about 204 branches, so a total of 587 branches. Of that, about 140 branches are excess, both from our side and their side. And those sorts of synergies we are in the process of extracting. So you will see this going down. And that is precisely why we have achieved a margin neutrality much ahead than what we had expected. And by margin neutrality, I mean that at a merged company level, we are where we were 9 months of last year. And that is because we have started extracting synergies out of the merger.
So, ma'am, by when do we expect the operating expenses also to fall in line?
The way we look at this is over the next 12 to 18 months, that is the time frame within which most of the parameters will start converging with HDFC Life's parameters.
So then can we expect VNB margins to go up from current levels? How would you guide us?
Yes. So rather than guiding on VNB margins, I think if you were to look at growth in VNB, because that subsumes both, you need to have top line rather than just margins per se, because even if I shrink, I can give you very good margins. So important is VNB, wherein it is a factor also of new business. That should continue to grow by in the range of about 18 to 20%.
How do you plan to stabilize the Excite business which you added? Because you said that your persistency went up for HDFC Life, but because of Excite, it's showing some weakness on a merged basis. When do you see that business merging or normalizing itself to the HDFC Life's business?
So this question I will answer in two parts. One is the back book. Back book means the policies that have already been sold and maybe sold 4, 5, 6 years back in time. There isn't that much we can do. Yes, we can move the needle to some extent, but once it has been sold back in time, then trying to contact the customer, because customer contactability is one of the serious challenges. Because people have moved, especially in smaller towns, difficult to reach, not really available online presence, digital presence, and so on. So that is one part, and we are working on what are the things that we can do on that front. However, on new business, so henceforth what they're selling, that over the next 6 to 9 months, that convergence should start happening with where HDFC Life is.
So do you see this differential in persistency to influence in the next couple of quarters as well, as you reach out to the existing policy holders and try to bring them into the fold?
Yes, this persistency should get better. Having said that, I want to add a different angle here, and that is one of the reasons why we found Excite Life to be very attractive is their strength in tier 2 and 3 towns. So persistency in these towns is different, and that is quite understandable to the more affluent metro population, and also apart from affluence, but also level of understanding as to why people should continue paying their premiums, even if they are in some sort of financial stress. So as we continue to grow our presence in other than in the metro cities, you will find that if you cut the data, non-metros will grow. Non-metros will have lower levels of persistency, not massively, but certainly lower by a shade or two. And so the level of persistency where we are today at about 87% is largely at a overall company level. At a consolidated level will remain more or less. But underneath, we will show you that metros, this is where we are trending on metros, and non-metros, this is where we are headed at. But within that also, we will show an upward movement. And this one point there is, that's not very dissimilar to the trends in mortality. So mortality experience that we see in metro, affluent, more affluent, salaried class, even non-salaried businessmen have better access to healthcare and so on, sanitation. But if you look at mortality experience in other than metros, it is a shade or two poorer than it is in metros. So similar kind of a analogy to persistency as well.
I have a question around protection. Our share in the product mix from protection has gone down by I think almost 2% in the when you compare the 9-month period. So we've always been very calibrated on the protection front, and that was all through COVID as well. But now that we see COVID phasing out and India, are we changing our stance? Is the share from protection going to go up in the overall mix?
So the way we look at protection is both retail protection. The numbers that you talked about is only the retail protection. The way we look at it is retail protection plus group credit protect, because both cover only mortality risk. One is directly to a single customer, while credit life, there's a master policy holder. It's typically a lender, and then to whoever are the borrowers. But that's what we cover. Even there are only the probability of death. And so if I were to look at that percentage, that has remained stable. In fact, it has grown by a percentage if I look over the 9 months. So last year, retail plus group credit protect was 13.8%. That's gone up by 1% to 14.8%. And if you were to look at standalone quarter, that has remained flattish at about 14%. So that's how we see it. However, retail protection, we remain fairly calibrated, like you mentioned. We have to look at risk management, but the opportunity is huge, and we are right up there in terms of being number 1, number 2 on the Google searches. So people are searching for protection, but perhaps taking a little bit longer to buy protection.
Ma'am, if you look at the penetration of insurance policies, and today we had the IRDH chief talking about that the industry needs to invest 50,000 odd crores every 2 to 3 years so that penetration can double in 5 to 7 years. From that perspective, what kind of capital requirement will the industry you would be requiring if that's the kind of steep targets which the regulator is putting in across all the insurance companies?
See, we recently last quarter did a pref issue and we raised 2,000 crores. I don't see the need for further capital at this point in time, at least for organic growth, as well as some of the initiatives that the regulator is nudging us to do. There is enough also if some of the solvency factors are further tweaked. For example, unit-linked solvency factors were tweaked recently, and that helped release some level of capital that was tied up for all insurers. So with some changes like that, risk-based solvency also will help release some of that capital, in which case we will have more. Right now, we have 209% solvency ratio. I think that could go up a little bit further as well. So right now, don't see the need for capital for any of these initiatives as well as growth.
From a group perspective, the merger of HDFC and HDFC Bank is expected in this quarter, in Q4. How does that synergy now bring in flow through to HDFC Life now?
See, HDFC Bank is our largest distributor. Now, when your largest distributor morphs into the avatar of becoming the new parent, then of course, a closer working relationship will be there. From our side, it makes a lot of sense, as well as from their side, because in terms of value maximization for the group, as well as cross-sell, upsell opportunities under the avatar of One HDFC. So all of those things will start panning up. These are all strategic level interventions, initiatives, and calls to be taken. And at the right time, as the merger fructifies, those calls will be taken. However, as a group, we are not waiting until that happens, and a much closer collaboration has already started.
Do you see that building up post the merger, completion of the merger announcement, or it can take shape before itself?
It has already started taking shape, and you will see more of it as the merger, like I said, fructifies.
But I think HDFC Bank already has 3 partners, including one of them is you. So how do we deal with the competitive intensity? Also, the regulators opened up now for more partnerships. So how is this going to pan out?
That's a question for HDFC Bank. But from what I understand, and also synergies, it is very evident. There's a reason why today no bank that holds more than 50% in a life insurer other than HDFC Bank, to the best of my knowledge, has embraced open architecture. Now, there's a reason why that is the case. And clearly, value maximization is perhaps the key reason, as well as perhaps ring fencing your customers. So some of those aspects will be considered by HDFC Bank in their decision. But from what I understand from them, there is no intention to sign on anymore.
Okay.
Finally, ma'am, we are heading to a budget which is coming up at the end of the month. From an insurance sector and insurance player, what is the kind of expectation that you have? We were the regulator were talking about composite licenses, where insurance companies can look at other segments as well. Do you see all those coming in, and if that comes in, will you be looking at such a license?
So we welcome any level of relaxation that would help various different models to emerge, and really it is in our interest to grow the pie than just redistribute existing pie, and that's how we see. To your question on composite license, this exists in many other parts of the world, and even when it exists, there are different avatars in the same country. There could be a particular view that to stay as a pure play life insurer or a PNC insurer, or some of the groups have embraced composite license. So these are all structural and at strategic level calls. I think those considerations will come through once we understand what is the regulatory framework in detail that finally emerges. So we'll have to wait and watch on that.
Expectation from the budget from an industry point of view and from your point of view?
So couple of things. One is that today annuity is double taxed, and that I believe is really needs correction. It's something that we have been appealing for as an industry for quite some time. And just to explain, when a person buys annuity, it is from post-tax income. Again, when a senior citizen gets the annuity in their hands, again it is taxed, and especially when they're the most vulnerable in their sunset years. So some kind of indexation or something like that to correct this anomaly. That's number one. Number two is ATC is a very crowded section, hasn't been touched for a long time, even for inflationary trends over the years. And if we really want to give, say, retirement or protection and impetus, even giving a little bit of messaging through ATC will do wonders, and ultimately it will help in nation protection. So some of those sorts of initiatives will certainly help.
Vibha Padalkar, it was a pleasure talking to you today. Thank you very much for joining us on BQ Prime.
Thank you for having me.
Thank you.